This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In today's video, I'll be going over the datasets, the earnings, and I'll be doing a technical analysis of the SPY, various precious metals, Bitcoin, and Treasuries for the week of January 19th, 2026. And this will be a longer video, but with that said, let's go ahead and jump straight into the data. Now, we don't have a lot going on this week. We have a holiday on Monday, so no market. We have Martin Luther King Jr. Day. On Tuesday, there's really no noteworthy data sets. We will have some earnings this week, so we will go over that after the data. But again, Tuesday, nothing major going on. Now, for Wednesday, we have President Trump speaking at 8:30 a.m. Don't know what he's going to be speaking about, but most likely it will be pushing or pulling on the market. Generally, his speeches tend to do that. So, um, looking forward to that, regardless whether you like the guy or not. Um, let's see, 12 p.m. I'm not really looking at the 10 a.m. data so much. The construction spending and impending home sales is important, but it's nothing that's going to really shift the market price too much. Unless we get some crazy print, but if we do, then I'll talk about that specifically. The Atlanta Fed GDP is at 12 p.m. Again, things have been running a little hot right now, and I will talk about that later when we start going into the Treasuries. And then at 1 p.m., we have the 20-year bond auction. Now, we have been seeing the long end starting to pull up very slightly, so my expectations right now is that we very likely will be seeing that pull up towards that 4.8%. I'd be very surprised seeing how the data has been over the last week and a half to see the yield start pulling down again. On Thursday, this is really the big day of the week. We have the jobless claims at 8:30 a.m., followed by the quarter-over-quarter GDP, which is extremely important. That was very elevated last time, and this time the forecast is expecting an even hotter print. For me, I want to say very likely we will see that just because the imports and exports have been really pushing a lot of weight into the GDP. And because of that, the numbers are very skewed right now to look extremely strong. So we're going to be getting higher GDP quarter over quarter until we start seeing the imports and exports rising back to their, the previous levels that they were at. Now, with that said, the initial and continuing jobless claims, we have been seeing these pull down slightly. However, with going over the JOLTS job openings and everything, and going over the Fed Beige Book, we know that companies really have not been hiring. We know that um, people have not been actively looking for jobs pretty much across the board. The people that have been not likely to succeed in finding one. Um, there's a lot of, I wouldn't say a lot of, there's some temp hires being hired in right now, but overall, um, a lot of positions are just really starting to close down headcounts. They're not really starting to do mass layoffs at this point. They were beginning to do that towards, when we were entering into quarter 4 of last year, but now everybody's trying to see what's going to be happening with the new year. Are we going to be seeing increased weakness with the consumer? Are we going to see things pick up to where all of a sudden now we need to start hiring again? So that's where we're at with the jobless claims. And with that said, the jobless claims has been pulling down. And while I think that's a good thing, but in this context, it's not because those jobless claims aren't being replaced with an actual job. That's the intended purpose of that. I believe a lot of the jobless claims are just falling off where they're not seeking, continued employment at that point. But that's something we will see with further data sets. Now, again, Thursday, that's the 8:30 time slot. For the 10 a.m. time slot, we have the PCE price index data slash personal spending. That's always going to be very crucial data. The core PCE year over year looks like it's going to be pulling down, at least by the forecast. But the personal spending for November is looking like to be up compared to, it's the month over month report for November. And we know that November wasn't exactly the weakest month. So perhaps we will see that come in at that 0.5% that they're looking for the forecast. The tips auctions is later in the day at 1 p.m. Most people aren't going to be paying attention to that, but I will be, as the tips can definitely be an indicator to where everybody's thinking inflation is going to be going in the long end. So I will be paying attention to that one, but I know majority of the market won't be. On Friday, we have the S&P PMI data, which is the manufacturing, composite, services, all at 9:45 a.m. And 15 minutes following that, we have the Michigan consumer and inflation data. This is the 1 year, 5 year inflation expectations, and then the consumer expectations and sentiment. We have been seeing a lot of these sentiments and expectations pulling downward. But with some of the data sets coming in, I wouldn't say hawkish or even hotter. It's just we've been seeing a little more strength in the economy overall throughout this winter season. And I think that very well can translate into a lot of these expectations starting to move back up again. So we will see. Again, this week really isn't a very, very busy week. Um, Thursday's that big day, but again, Wednesday with President Trump having a speech, that can definitely shift things up and completely change the market direction. So we will be tuning into that. But other than that, pretty relaxed week for the data sets. And very quickly before we get into the earnings, I just wanted to show the CME expectations for this next FOMC meeting. And currently, they are very, very likely to stay with the rate pause compared to the rate cut. And I know that I was personally expecting that 25 basis point rate cut, but I believe with a lot of the hawkish slash hot data sets that we've been seeing, this is really just locking in the Fed to say, okay, let's go ahead and pause another month and let's get more data. Let's see further results from when the government was shut down, and let's, basically kick the can another month and see what happens. And just from the overall sentiment, I know some of the Fed members are fairly dovish right now, but I think the sentiment overall is just let's pause and just wait. Again, I don't think that's correct. I do think that the labor market is seeing some major issues and that without cutting the rates, we're going to, you know, see things really start to spiral out of control a little bit. But, you know, we do have to wait for the data, and the Fed is data driven. So if data is saying that things are starting to get hotter again, then the Fed will have to be in a position to pause. So that's really what's priced in is that for this next meeting, which is 9 days away, they are very, very likely anticipating a pause. And this can shift greatly if we get some data this week that is extremely dovish. For example, if we get the jobless claims skyrocketing, or if we get the GDP quarter over quarter just plummeting, something like that would shift this back into where the Fed might need to cut again. I know Fed's Bowman was saying that um, basically that the Fed needs to be focusing entirely on the jobs aspect of their dual mandate because the weakness in the job market and the labor market is starting to become very, very serious. So just wanted to go over that before we jump into the earnings. But jumping into the earnings, again, Martin Luther King Day on Monday, no earnings. On Tuesday, we do have US Bank in the morning. I don't really care about that too much, but we also have Netflix after close in the afternoon. That's always a very big earnings. Even though it's not exactly a tech company, it's basically one of the major mags, so it has a ton of weight in the market. Um, Going into Wednesday, we have J&J. Nothing really interesting there too much. Same with Thursday, it looks like. Procter Gamble, GE. We do have Intel. Intel's nice. So basically, it looks like Netflix and Intel for this week. Blumberger, I made some money on that before. It's a weird one. It's a bank. Don't ask. Um, yeah, Netflix and Intel. I really don't have any opinions on either right now. Yeah, I'm not going to be playing either of these earnings. And going into the week after this, I think this is when the big earnings start back up. This is Tesla, Microsoft, Meta, Apple. Yeah, all the fun stuff starts up next week, not this week. So this week we get a little taste of it with Netflix and Intel.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And jumping into the SPY technical analysis, I will be going over this fairly quickly. In tomorrow's video, I will go over the SPY a little more detailed. But for tonight's video, since we will be covering not just SPY, but precious metals, treasuries, Bitcoin, I want to make sure that I'm able to properly give everything enough time. So this will be short. I apologize for that, but let's go ahead and jump into it. Last week, we did see a little bit of wonky price action. On Friday, we had a little bit of a selling day, even though I was truly anticipating seeing buying that day, but we saw the VVIX pull up, and we saw a lot of signals that just told us not to buy calls. Um, Going over the moving averages, we will be seeing the FIMA pulling down because of that Friday close. The close on Friday took the price to 691.66. I have the FIMA set towards that 691.65 range. It'll likely be around the 691.80, but that really depends where the price opens in the pre-market. Now, a few things we need to look at is that the upper Bollinger and the lower Bollinger are starting to curve inward, which is one of the main signals of consolidation. We're starting to see the 5 mile challenging the 10 mile as on Tuesday when the market opens, the 10 mile will actually be above the 5 mile very, very slightly. Or they might be literally right on top of each other, but that's starting to become a little bit dicey again. It wasn't this bullishness we were seeing before where it was pulling away from the 10 mile. Now we're starting to see that consolidation within the short end of the moving averages. Now, the 20 mile has continued to pull up and it will continue to pull up um, unless we start trading massively below that price. But with the 5 mile pulling downward, with the 10 mile slightly pulling above the 5 mile, this now leaves the range for the 5 mile to start challenging this 20 mile range. Now, we did have an actual 20 mile test occur on, I want to say it was last Wednesday, if I remember correctly. And with that 20 mile test, it was very brief, but it was enough to be considered an actual 20 mod test. And from that 20 mod test, we had a 5 mod test. Now, with that 5 mod test, and this was leading into Friday's price action, I said that either with the 5 mod, we're going to have a basically an acceptance of that level and see it bought upward to the upper Bollinger, and that we would see the VVIX pulling down when that occurs, or we would see selling back down towards this 20 mile from a rejection of the 5 mile range. Now, so far we haven't fully rejected the 5 mile, but this is looking extremely, extremely likely if we see continuation of that rejection. Meaning, if we see the price start selling from the 5 to 10 mile level on Tuesday towards this 20 mile range, then the 5 mile will be pulling underneath the 10 mile and start pulling towards that 20 mile, which again, this isn't something we've actually been seeing since around early last December. And that was just a very, very brief moment where we saw the 5 mile pulling down into the 20 mile. But ever since then, the 5 mile has been making its way upward. Even since that major correction, I wouldn't say major, but that decent sell off we had in November. Now, what that is implying is that potentially we could be leading into another sell off here. Once we start seeing this 5 mile challenging the 20 mile, that's when things start to get very bearish. Okay, each time the 5 mile is below the 20 mile, that's when it's basically open bear season. Um, when I look at the 20 mile, that's basically the midpoint between the bullish upside and the bearish downside. When we start seeing our lower, or I want to say our shorter moving averages moving below the bearish downside, then that's saying that not just selling's occurring, but it's occurring to a point that we're seeing it within a 5-day moving average, we're seeing it within potentially a 10-day moving average, and that's how you get some extreme selling. We also see the ADL pulling downward, which means that actual funds are being taken out of this symbol, which is the SPY, obviously. So there are some selling signals. Now, was this just a brief volatility pop? I'm not entirely sure. We will know again come Tuesday/Wednesday when we can actually see the VVIX, when we can actually see if we're going to further reject this 5 mile range. And that's really the key is, are we going to reject the 5 mile, or are we going to see buying from the 5 mile upward? So far, we've been playing around this range a lot. We've been getting to this really dangerous range that I've talked about where we're above the 5 mile but below the upper Bollinger, where it's just kind of choppy water. um, we haven't had any massive moves in quite a while, and what I'm really meaning by that is we haven't had an upper Bollinger move or a lower Bollinger move in quite a while. The market is really preparing to do so, and how you know that's occurring is when the Bollingers start curving in. When the Bollingers start curving inward, that's when you get your big, big pushes, either upward or downward. So it's preparing for a move to that level or to the level underneath it. So that's the daily. It does not look good. Um, if we see massive buying from here, if we see the all-time high taken again, then this can turn very good very quickly. Um, but we're kind of between that range where it can turn very bad very quickly, or it can turn very good very quickly. Um, Basically a very strong consolidation range. If we get back to the 20 ma, you're going to want to straddle that very likely. I know that I will be. Straddles again are calls and puts dated outward. I will very likely just buy contracts that are at the money, nothing major. Now I want to go over the 4-hour time frame very briefly, and apologize for all the drawings in a second. But we do have some drawings to go over. Of course, half of my stuff deleted. Okay. So I'm going to draw these cups really quick. And we've been talking about these structures for quite a while now. We have been seeing many of these cups and handles forming. I want to draw that cup better because it's actually up here. That potentially that is what we're looking for here. We've been kind of seeing the same structure where we have this bullish large cup form at the bottom of the cup. We see the inverse head and shoulders. It pulls upward. At the top, we have a bearish structure, which is the head and shoulders, very, very generally on each of these. And I did have them marked there, but for some reason they deleted basically this purple range right there, right there, and right there. Those are our bear structures pulling us downward to allow further bullish liquidity if we're going to continue pulling upward. Now, thing that I'm seeing here is that each of these cups are getting smaller and smaller. So is that saying that our upside is tapering out? Are our buyers tapering out? Or do we just need to push a new level above this? Is that what this is saying? Hard to tell. Um, what I do know is that the trend is heading upward. That's something that we cannot deny, is that the trend is heading upward. Our bottom supports are telling us that this is being pushed upward so far. But the main concern that I have is that we have this micro selling channel here, which that's not really what I'm worried about. What I'm worried about is this consolidation channel, which is between these two white channels. Being at the top of one of these ranges is very, very likely telling us that it wants to pull all the way down to the bottom. So if we break down into this range again, if we continue seeing selling, that's telling me that very, very likely it wants to take the bottom of this channel. Seeing where the lower Bollinger was, I believe it was at 677. It's already in this range to start being engaged upon. So if the market really wants to start selling off and closing potentially some of these very large um bearish structures, if they're going to be bearish structures, right? Then selling would be very reasonable here. This upper Bollinger rejection that we've been seeing would be very reasonable if this was just controlled selling. Okay. This week is very, very likely going to determine the outcome of this controlled selling or buying. Because if we're going to see another cup form in this range, one, it's going to be smaller than this cup, which gives it less room to move. And two, with less room to move, that means we have more of a chance of a breakout or breakdown. So continue watching your structures. When we're getting to these very, very crucial moving averages, again, it's very, very simple to pull the VVIX open, see what's going on with it. Very quickly going over the VVIX again. If you're in the red zone, that means that the SPY is very, very likely seeing selling. If we're in the yellow zone, very, very likely the SPY is seeing consolidation, and this can be both buying and selling. If we see it enter into this green range, then that means that almost no selling is taking place whatsoever, and that basically we should be fully anticipating upside. Now, in Friday's session, we were sitting in this 100, I want to say it was 101, 100-ish range almost the entire session, which tells us that there was selling occurring. And that's exactly what we saw within the price action on Friday. I can pull up SPY, turn off the drawings, and that's exactly what we saw on Friday's trading session, is just a lot of that tapered selling. So the VIX or the VVIX is pulled up very, very heavily right now. but again, it's a tool that can shift drastically. I mean, I've seen it go from $80 to $130 within the same session. It can move very quickly, so it's a very active tool. Come Tuesday morning, this should be one of the first things you're looking at to see if the market is buying or selling. If it's selling, then we will see a continuation upward within this range in the VIX, because again, that's telling us that we're going to continue selling. If we start seeing it pull down and start challenging that consolidation range and even potentially start pulling into the green range, that's telling you that very, very likely we will be seeing buying on the SPY. Now, again, last week I don't like trading into OPEX, so that's why I took those couple days off. With that said, we have a shorter week this week, and we do have FOMC not this week, but next week. I am going to try to keep my trades pretty light unless I see an extremely clear direction form. Um, with that said, look forward to tomorrow's video for the SPY because a direction will very, very likely be presenting itself quite a bit more, and we can discuss that a lot more in detail. But yeah, with that said, going to end the SPY TA here. We just have to be very careful. We've been seeing a lot of bullish structure, but if this bullishness is tapering out, it's going to start selling down very, very hard. And that's what I'm concerned about. I don't think we're going to see that, but it's starting to become a concern. So, um, with that said, share that concern with me. I would not be overly bearish or bullish right now. There's a lot to unpack this week. And getting into our precious metals, as always, let's start with gold. This is the actual futures, or no, this is the symbol GLD, the ETF. I'm not going to be looking at the moving averages so much. For this, I want to focus more on the Bollinger movements. So, what gold is telling me here is that we've been pushing the upper Bollinger quite a while. Um, Pretty good movements too. It hasn't been choppiness, it's been actual upper Bollinger moves with support tests back to the upper Bollinger, which means what comes next? Support test. Extremely, extremely, extremely likely. Now, with this support test, this does not mean you're pulling back to the 20 ma, and that's what the middle Bollinger is, so don't mistake that. This is the exact same thing as the daily 20 ma, so when you're looking at these Bollingers, you should be seeing it as upper Bollinger, 20 ma, lower Bollinger, not middle Bollinger. So with that said, we have just left the upper Bollinger. With us leaving the upper Bollinger, and with us having tested the 20 ma, not even a month ago, we do not need to test the 20 ma to continue upward. At least this is what gold's telling me so far, and I'm going to take a quick look at the futures as well. This is the GC main. This is telling me almost the exact same thing, all except they're getting that gap upwards. So they had a 5 ma test in here, and that's what that handle downward is. That's that support test. Same within here. How you see they had the 20 ma range being tested, pulls up into the upper Bollinger, has these 5 ma support tests. From there, either they can pull down into the 20 ma or they can push up again. Now, from this 5 mile test, it's looking extremely likely that it's wanting to continue pushing upward, which means that we're going to be seeing all-time highs once again, very, very likely almost up to this 14 or 4,800 range. Okay, that's really starting to become that next gap that we're looking for. With the upper Bollinger currently being at 4713, that does have some range to expand upon. So remember, once we push into the upper Bollinger, you should expect a higher high from that uh, from the initial push. So that should definitely tag us into that 4750, 40, 4780, 4820-ish range. give or take. There is a little bit of leeway in there, so just be cautious if you're looking to take profit anyway. Um, I know some people are scalping within here, which there's a ton of money to be made scalping gold right now, let me tell you. Um, Same thing goes with the gold ETF here. Very likely when we see this open, it's likely going to gap up because we see the GC main gapping up. And very likely because metals tend to share a spread, and this is kind of like treasuries as well, where if one of the instruments in that spread or one of the securities in those spreads moves, then everything else will follow in some form or another. And I'm going to show you this with silver because extremely likely silver is moving upward right now as well. Let's see, silver, silver, silver. Here is the CAG, which is the XAG USD. This is silver. It is indeed moving up. It is indeed closing this cup back up to the all-time high. Very, very likely you're going to be getting additional upper Bollinger push here. Again, I've been very, very bullish on metals. Going over to the actual silver ETF. SLV. We have purchases back, I want to say is at 30 or not 34. It was at 45.32. So it was back in this range when we had a dip and we're still holding shares. I'm still holding a large majority of my precious metal shares right now because I don't think that this run is close to done yet. Silver looks a little overextended and I would be cautious of that. You have not had a 20 mod test in quite a while. You haven't had a 20 mod test since November, so it is definitely due. But again, if you're going to have a 20 mod test slash sell off in silver, the market cap is massive. It will also hit gold, it will hit palladium, it'll hit platinum, and yeah, really, silver and gold look great right now. But if you're looking for the major dips to buy into, always wait for the 20 mile. If we're going to have a massive sell-off to truly, truly dip buy into, you wait for the lower Bollinger. And that's when we got many of our members to start buying into silver was back at that lower Bollinger because that's exactly when you start buying. A lot of us, excuse me, were buying gold back then too. I know my gold shares are up, I want to say over 60 something dollars a share right now. Excuse me, I can't talk right now. But we were starting to buy shares again back at this 360, 370 range because we knew that that lower Bollinger within silver being below the 20 ma, plenty of signals telling you that we were going to head up further. Now, overall, I am still extremely, extremely bullish on gold. I do believe that if I can scroll back to it, I'm sorry. I do believe that gold will be seeing, I'm going to tell you the exact level that I anticipate. That's 72. 72 is close enough. We'll do 72. Right there. I want to create, I'll just do a horizontal line for now. I wanted to do a horizontal ray, but um, that's what I'm expecting the price to get up to. Now, granted, this is going to take years. Okay, this is going to take multiple years. But I want you to think about what has happened to gold within the last just year and a half. You know, going back to just 2024, we saw gold. What people thought were telling, or people were telling us, this was the total upper limits that we were going to be seeing gold at 27, 2800. Look where it is now. It's doubled in price. We're close to this upper buying channel. But we still have a lot of room to go. We still have a lot of consolidating to do. We still have a lot of upside to take within gold. So Would I be selling off right now? Not yet. I'm not really seeing signals of selling off yet. Again, I still see massive upside within gold. I still see massive upside within platinum and silver and everything is as well. All right, and quickly going over Bitcoin, and I can actually finally pull up my indicators. So for once, we will have the Bollingers to look at. Now, I'm going to show you my drawings and everything in a moment because I'll be telling the picture a lot better. But just off of short term, we see that Bitcoin pushed into the upper Bollinger. From that upper Bollinger push, we had a 5 mod test. From that 5 mod test, we had a rejection. Okay. Now, we do have a little bit, sorry for all these drawings, I'll explain them in a second. We do have a little bit of a bullish structure forming in here. However, it's extremely close to breaking. And if it breaks, it's going to form bearish structure to the downside because you actually have a very nice head and shoulders forming here. And one thing that I also want to highlight, which I'm going to turn off the Bollingers to do so for a moment, is that we have this major consolidation channel. Okay. This is the bottom of that channel, and being below that channel means that extremely likely if we do not see buying above it, for example, if we don't see some of these cups forming to the upside, then the very high likelihood is that we're going to trade from the top of this channel towards the bottom of this channel. If I can drag my cursor, there we go, towards the bottom of this channel. Now, this channel has a very dangerous area, and I'm going to mark this in an actual rectangle, probably in tomorrow's video or something. But this liquidity range right here is a very dangerous set of liquidity. If we continue pushing downward, then this is creating the inverse handle to our inverse cup. And I'm going to zoom out just a little bit to show how large that thing is. This thing has been a monster. It has taken months and months and months and months and months to build this thing to be able to push downward. We have been following extremely strictly within our major selling channel. And I'll show you a weekly or monthly chart of this Bitcoin chart because I've been charting this for years and years and years and it has been following to the T. Now, if we continue down this channel, if we do not see buying above this lower consolidation range, then I can almost guarantee you we're going to see massive selling to the downside. Now, I have this 17 point, or not 17, 74.4 thousand marked for a reason. That's an extremely dangerous leg down, which if we're going to get major selling to the downside, that's going to start being tagged. If we see selling, the lower Bollinger is going to start opening, and look at where it opens right into. If I can drag it, it opens right into that very dangerous liquidity range. If we enter that dangerous liquidity range, that closes this inverse cup, telling us that extremely likely we're going to see much further downside. Now, as bearish as this thesis might be, not everything is bearish here. Again, we still have that bullish structure I highlighted earlier. We are still well above the dangerous liquidity zone, and so far we have not built a inverse cup or an inverse handle on this larger inverse cup. So far we've actually been slowly trending upward. If we can keep this upward trend, if we can break above this consolidation channel bottom, then what happens from there is that consolidation channel bottoms trade from the bottom generally to the top of that channel. And what does that do? That closes a major cup to the bullish upside. And not only would that close a major cup, that would become an extremely large double bottom. On the weekly time frame, that thing would be very, very gnarly. I would be telling you that Bitcoin's going to, the 150 plus, um, 150,000 plus. And again, I'm not bearish on Bitcoin right now, but I do see at least a lot of reasons why it can be bearish. Um, I really think that Bitcoin and the precious metal markets are competing for market cap. I think that pretty much this entire downside has been reflected almost exactly into gold's upside. You can see that right there, right in that daily time frame. The Bitcoin pulling downward, starting to pull downward. Meanwhile, gold's going upward while it's pulling downward. So a lot of market cap is shifting into precious metals from Bitcoin. And I guess the overall question is why? Is it because Bitcoin is easier to liquidate for collateral? Is it because precious metals do potentially a lot better in low interest time periods and um potentially rising back up into high interest time periods again? Precious metals aren't locked to an interest rate, so it doesn't matter if the yield or if the interest rates are 100% or zero. Precious metals don't have any form of treasury yield behind them. So I know that, excuse me, I can't talk today. I know that a lot of people are really targeting precious metals for that aspect. And by people, I really mean major institutions, banks, especially a lot of banks. And something to cover with banks really quick before we kind of segue into our last section here with treasuries is that banks tend to buy things they know people want. Okay, so when we see the banks who were buying a ton of silver, who were buying a ton of gold, who were buying a ton of long end treasury bonds, who were buying a ton of short end treasury bills, they buy those assets or those securities to sell for a profit, very, very likely, or to benefit from some sort of yield. Okay. When we're seeing banks continuously buying precious metals and continuously buying long end yields, that's telling you something. That's telling you that either one, they're expecting the rates to drop very drastically so that they can be the seller of those instruments, or two, they're seeing some major headwind to that they need these instruments and securities to be able to stay afloat. It's one or the other. It's not both. So that's what we're really trying to determine here. So with that said, let's go ahead and jump into the treasuries. This is my TLT chart. What you're looking at here isn't just a bunch of colored lines and drawings and indicators. This is a story of what's going on with the United States and global economy. Now, I have not been correct in the short term for TLT, even though we are seeing that upward pull. I was not correct in the fact that I was anticipating a fairly quick push up to that 92 range, potentially even the 97 range. Um, Potentially back at during late November, which that would be right towards this range. This is when I was expecting things to curve back upward. However, we did not have that curve back upward. Okay. The government shut down from, geez, I want to say it was September to, I don't really remember exactly. It doesn't matter, but it was like a 40 something 50-day shutdown. It was the longest shutdown in history, and we had no data for quite a while. Now, ever since we've been getting the data back and just turning off the drawings and everything for a moment, what has Treasuries been doing? Pulling downward. Um, and let's just look at the actual yields themselves too. So that goes back to 1021. See 1021. And here we go. basically 1021. What have we been seeing with the yields? We had a massive pull upward, and I do say massive. This is the 10-year yield. It went from all the way from 4.1% all the way back up to almost 4.8%, which is massive, 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 massive. Now, since then, we had that pull back downward. We were lucky enough to see the 3.9%. And from that 3.9%, sorry, it's hard for me to talk today, we saw potential continuation of what we were expecting is that the yields were going to continue downward. However, that's not what happened. We saw it pull upward very quickly. That was just a very, very brief move, and since then we've been seeing consolidation, little bit of downside, but consolidation. Now, so far, and literally since October, and I wish I could draw on this, it's not going to let me. Uh, sorry, I want to see if it'll let me draw. It won't. What a shame. Um, since that October point that I pointed out, what has the yields been doing? It's been slowly creeping back up. Now, this week we're anticipating fairly hawkish data overall. That means that very, very likely we're going to be seeing the 10-year creeping up further. How much further? That's hard to say right now. Are we going to continue keeping this selling channel that we've been holding? Or are we going to start seeing this pull back up to this 4.4, 4.5% and really start shifting the narrative again? That's going to play out very soon. It could be a week, it could be 2 weeks, but we are going to have a very, very drastic reaction in the yields very soon. Anytime we see consolidation like this, massive moves occur. Anytime we see consolidation, massive moves. Um, I'm not expecting the consolidation to last very long. Again, consolidation, massive move. Consolidation doesn't last very long in yields. The world is shifting too quickly. It's shifting too fast. There's just too much going on for the yields to sit in the same spot. Now, we have been consolidating for quite a while. We've been literally consolidating since early or mid 2023. Yeah, early 2023 essentially. We've been seeing that consolidation. A lot of that was the elections, going into the election year. We were seeing the rates shift up and down. We saw them pull down quite a bit beginning right towards the beginning of the election, and then they pulled upward very, very greatly, very quickly. And that was even with a Fed 50 basis point cut. Um, Followed by, I believe we had a 25 basis point cut in December, if I remember correctly. So we're seeing a lot of consolidating here. All of our instruments are telling us we're seeing consolidation, which in the broader aspect of things, seeing how we're seeing continued labor market weakness, we're seeing continued consumer weakness, even though the data sets have been showing a little bit of strength towards that. Um, We have not been seeing a weak GDP, but then again, that is because of the imports and exports drastically bumping that number upward. If we had standard imports and exports, I'm sure those numbers would be a lot lower. We have unemployment drastically pulling upward from almost every single major state. It's been pulling upward pretty drastically over the last few years now. We have just many different signals that are telling us that the yields want to pull downward. However, this is the thing that's really holding us back, and it's the Bank of Japan. The Bank of Japan and China were our largest debt holders for an extremely long time. I believe Japan is still our largest debt holder. China throughout the last year has been absolutely selling off their yields or their US Treasury notes. And the reason why they're doing that is to get cash collateral. They have been having a very, very bad economy. They've been seeing their housing sector and everything just going to the dump. They've been needing money, so they're selling securities in order to do that. I'm not worried about China. I really don't care if China sells every single US treasury it owns. I don't care about that because somebody will buy those treasuries. Who I do care about is the Bank of Japan and Japan as an entity as a whole. And they are starting to question the long end aspect of the treasuries. Now, when I say they're starting to question, I mean by the fact that you get long end treasuries to hedge for um, major economic events, meaning labor market crashes, housing crashes, um, massive consumer just pauses where consumers just all of a sudden stop spending. Um, there's a lot of different reasons why you would hedge a long end. And we're starting to see a lot of people not see the necessity for that anymore because the long end is so far dated that it's not clear enough to how to price that in. It's not like we're in a zero interest rate policy market where we could just fully anticipate that the bond yields will eventually go up. We're not at the yield heights where the anticipation could be fully on the downside. We're still between this choppiness where potentially we could see Japan having to sell almost all of their US treasuries just to kind of save their currency. Because the US yen or the yen has been dropping drastically, and that's what this chart really shows. And this is the USD JPY pairing. This is showing how much yen you can get per dollar. So when this is going up, the yen is drastically weakening. Now, I talked about this in last week's video and probably many, many times before. Once you start getting to this 155 point, the Bank of Japan almost always starts to intervene. Now, what does that intervention mean? That means they're selling securities. And by securities, that's MBSs, that's treasuries, that's short term bills, that's stock equities, that's options. I mean, you name it. If it's a security that's able to be traded for cash to be able to buy the yen back and lower the price, that's what they're going to do. Now, I do believe we've been seeing a little bit of this unwinding over the last few days because it did pull all the way up to 159. Again, that's massive, massive danger zone. The last time it pulled up to this 162, this is when we had that massive, you know, the yen carry trade unwind happen, and that was early August of 2024. We saw it pull up to 162, and from that range, the Bank of Japan had to sell off tons and tons of stocks, treasuries, crypto, you name it. They were selling off everything to buy up the yen, got back down to that low, creeped back up, and this is during the early 2025 sell off, by the way. Pulled back up to that range, and all of this selling is during the selling of the 2025 sell off. Okay, so now we're back up to that range again, and we're starting to see not exactly bearish signals within SPY and tech, but we're starting to see somewhat bearish signals where the trends can really start to shift pretty drastically and pretty quickly. Um, you need to keep your eyes on this because if this continues rising, then the Bank of Japan has to start selling securities to save their currency. Selling securities means stock market dumps. Simple as that. Almost every single time you see the stock market dump, you can look at this chart, inverse it, and that'll be exactly what you're looking for in the stocks. Um, so yeah, that's what I wanted to cover. I think I covered pretty much everything I wanted to cover in the short term. With TLT, I guess the real question is what to do with TLT in terms of contracts, because we're still in this indecisive range where we can continue upward, or again, we can start seeing these economic events starting to pull us downward. Now, I've been telling people to take contracts for months now, and I'll fully identify my mistake here is that I've been telling people, I want to say back in October, November, to be taking contracts for December to catch not only this 92 range, but that 76 range. We did not get that move at all. All those contracts absolutely burned, and that did very poorly. Okay. Um, Again, I can't control that. I can only use the technical analysis that I have to determine the best of my ability. Now, our next target is this March target. If we're going to be seeing upside, just following the base of this buying channel, which TLT has been respecting, if we follow just the base of this buying channel to the upside, by the middle of March, we'll be around $90.20, give or take. If we're seeing the exact same price action we're seeing right now. And that's not assuming the dividends or anything. The dividends do take away from the price, so do remember that. But we are seeing bullish action within TLT, which does mean that very, very likely we will be seeing the yields dropping. Now, by dropping yields, that still might look like the yields are green. That might look like um, the yields are pulling upward, but a lot of that is the bull steepening. And until we see actual strength in the economy and the market to where the yields are going to start pulling back upward to where the Fed has to consider having to hike interest rates to stop upward inflation, that's when you really start to worry about TLT. But with the current cycle, we have many, many banks buying long ends. We have Jamie Dimon, who, again, he's the CEO and owner of JP Morgan Chase, the best bank in the world. He has been absolutely loading on long end bonds. He does not call the RMP process RMP. He calls it specifically Fed QE, and he even said in his latest speech that he gave on Friday that this RMP program is not RMP, it is specifically QE, and it will shift into the Fed buying bonds. Specifically his words. Um, what that means for treasuries is that QE for bonds means that they're buying the long end, they being the Fed. That means that the banks want to be the sellers of those notes. That's why they're picking up the long end. They're anticipating TLT and yields to, well, TLT to rise. They're expecting the yields to drop very, very drastically. And that's from the bank's perspective. Now, we do have to take that with a little bit of salt because the bank can hold assets and securities generally a lot longer than what retail can. Um, they're not caring about March strike options. They're caring about what happens to these bonds and everything, you know, 8 months to years from now. So our time frames are a little different. Are we going to see TLT pop before that time? Personally, I do think so. I do still see all the signals that we need to be seeing for TLT to have the type of movement that we want. But we still need to be cautious because in the short run, things can shift very, very quickly. And as you saw with this bullishness we were expecting, that government shutdown really, really killed the move. It stopped all of the data sets, and without data, TLT just is not going to push upward. We need data saying that, the Fed is easing their policy, that, the labor market is struggling, things like that to push buyers into the long end. So again, overall, I am bullish on TLT. I've been holding my TLTW shares, and they have been seeing actually great weight so far. I've been pretty much loading these, I want to say since like March. Um, and they've been doing very, very well. I've been seeing consistent growth in my TLTW, even though TLT has been getting absolutely hammered. So again, you just have to play this very carefully. My suggestion for most people is to be putting it into TLTW because that's a monthly dividend. It's an equity, so it's not like you're burning money on options. I haven't checked the last month's yield, but generally it's going to be paying over 15 cents, which for a share you're paying 20 bucks for, that's really not bad. Um, Especially because the bonds are in a bear market. Once we get the bonds seeing upward buying, once we see the yields pulling down drastically, then that TLTW dividend jumps all the way up to 75 cents a month, if not more. And I've seen it. I've seen it actually happen. Um, that's why I've been taking a lot of TLTW. I believe between the TLTW shares and the actual TLT shares, it's pretty much a no-brainer to just buy and hold, especially at this level. I don't see the downside being much further, but if that changes again, I will be bringing that up to you because I do monitor the bonds very, very closely. Um, I know many people like to make jokes about me not being able to monitor the bond market, but I've been doing it many, many years very, very accurately. Yes, this government shutdown caught me, and I do apologize for that. The bond market is extremely difficult, but let's just keep going one day at a time. Let's keep following these data sets and let's determine when the big money is really going to start piling in. Now, I'm not going crazy on these March calls. I have a few positions. Um, Likely I'm going to try to take some leaps. Um, I think that's likely the key to this all is taking some leaps for next year, which if people are interested in that, if people are still watching the video by this point, go ahead and comment in the comments, and I will specifically take a look at some strikes for you in the next video. So, with that said, I'm going to go ahead and end today's video here. I know there was a lot to go over. We went over, the data sets, the earnings, SPY, precious metals, Bitcoin, treasuries, but I really wanted to give everybody an overall grasp of where I see the market going. And currently, what I see is a lot of indecisiveness within the SPY. I see uh, Bitcoin wanting to pull down for some support, but potentially to have a pretty massive sell. I'm seeing precious metals having a lot of weight, still potentially a massive amount of weight within gold and everything. Just you really do need to buy the dips. Just make sure you're buying those dips properly and you'll catch the upside. Same with silver and for treasuries. Um, just be careful with the options, but the long-term equities have been holding extremely strong. And actually, most people that have been buying them when I've been saying to buy them are up pretty drastically in their positions. So, with that said, I'm going to end today's video here. Thank you all for watching. I appreciate each and every one of you. You all mean the world to me. Thank you, thank you, thank you. Um, With that said, I will talk to you in tomorrow's video. Thank you for watching. Take care. Let's make this week an awesome trading week. I know that last week was a little sketchy, but OPEX can always be a little sketchy, and let's make it better with this week. So, take care, everybody.